Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a market wrap up for the week ending September 13th, 2024, as well as some trading levels for the upcoming week of September 16th. What we're going to do is we're going to look at some of the major market indexes, specifically the SPY and the triple Qs, and we'll also look at a few popular company symbols. Before we get going here, the usual disclaimer, Precision Trading Labs, we are neither money managers nor financial advisors. Nothing here is to be construed as investment advice. Everything that we're doing here is for informational and educational purposes only, and in the case of our subscribers, is to help them on the journey to becoming confident, successful traders. So here's the quick review of the market for the past week. Right here, this line here is we're looking at a daily chart here, incidentally, of the SPY, the ETF, of course, of the S&P 500. This was the close the prior Friday, September 6th, and you can see after that these are your five trading days since then. And so we obviously had this nice move from the close of that Friday through the close on the 13th. And so you can see that's about a 4% pop that we had during the week. So that was obviously a nice move on the SPY. If we take a look at the Qs, it was even a greater move. Right here, here was your close on the 6th, and then here was the move, the close of yesterday, and that was about 6%. So obviously a very nice day in the market there. Okay, and a good week. So that was the market wrap up here. We actually have some levels on the market indexes as well as a number of these company stocks. Before I actually start to show you those, what I'm going to do here quickly is to show you a sequence that we had recently on a trade with Carnival Cruise Lines, and I marked it up here in order to show you the underlying principle and foundation of how our trades are constructed. All right, so let's take a quick look at that here. So this is a daily chart of CCL, Carnival Cruise Lines. Okay, and here just to take, and so right here, this was a level of interest here, and this was a level of interest down here. Okay, so that was a level of interest that basically ran from about $12 to $13 underneath the price at the time, which was about 15, and then above here there was a level that was sitting at around 1710 to 1760, and so those were these two levels that I was looking at. And so what I'm going to do is I'm going to kind of tell you about why these were two levels that sort of caught my eye, and what was that these are going to be the basis for trades for us. Up here, this would actually be the basis for a bearish trade, and if price pulled back to here, dipped over here, this would be the basis for a bullish trade. All right, so I'm going to take you through the thinking about all of this here. So here we go. Right over here, price came down, and then notice it consolidated there, and then notice right there was a very, very bearish move that occurred here. And again, this is a daily chart, so each one of these bars, of course, represents one day. So that's a very, very bearish move there. Closed right at the bottom of its range, at the bottom of its trading range for the day. Okay, this is another pretty bullish move there. Excuse me, bearish move there that closed at around roughly the bottom 20% of its candle here, and then there was a gap, and then another bearish candle, and then this thing actually gapped down here, and then it started a recovery here. But essentially the move from this consolidation area to all the way, you had a move from there, from about 1710 all the way down to about 1380. Okay, so that was about what, a $3.40 move or so. Okay, so that was the foundation of a trade. And what's going on here is that within this range, um, essentially buyers and sellers were in agreement in terms of the price that they thought that they should either be buying or selling at, and it was a relatively narrow range, about 40 cents here. Okay, and so we can think of this as kind of an equilibrium where buyers and sellers are in agreement here, and then buyers and sellers essentially went out of agreement here, because what happened here was that there was a sudden exhaustion of buyers. No one was willing to buy up here anymore. Okay, and essentially what happened was the sellers had to run down the price chart until they encountered willing buyers. Okay, and so within here, if you think of the shares that are offered up by sellers, we can think of that as the supply of shares that are in here, okay? Similarly, we can think of the shares uh, that are required by buyers. We can think of that as the demand for shares in this region, okay? And so within this region, buyers and sellers were in agreement and supply and demand were in balance, okay? And then right here, supply and demand go out of balance, okay? And so what happens is, again, this sudden exhaustion of buyers here, okay? And so when the buyers disappear, all you have left up here are sellers, okay? And so again, as I said before, sellers are essentially can be equated as as supply, okay? And so right here, where we had supply and demand, all of a sudden now left in its wake, all you have left is supply. Hence, we refer to this as a supply zone. And when price returns to a supply zone and it meets certain criteria in terms of its structure, in terms of the move out of it and the distance and the energy of the move out of that region, okay, if it meets various evaluation criteria, when price returns to that region, that is the foundation for expressing a bearish trade. Okay, and of course, expressing a trade up here, the most straightforward thing, of course, would be to sell, to short Carnival Cruise Lines. But of course, another way to express a bearish trade over here would be to buy a put. And if one was a fan of collecting premium, another thing one could do would be to sell a bear call vertical credit spread. Okay, and one could then collect premium up here and capitalize on time decay. And as long as price didn't drive through the zone, you would make money that way. But in all three cases, you would express a trade based on this zone here. Okay, and then right here, this is how we structure the trade. Here's our entry. Right there, there's our stop out if price goes through this zone, and then we give it a little wiggle room on top of that. We gave it an extra dime here. But essentially, that's our trade. Okay, entry there, stop out there. And then these rungs of this ladder represent risk and reward. That would be a 1-to-1 trade. That would be a 2-to-1 trade. That would be a 3-to-1 trade. Okay, so that's the narrative about that zone up here. Okay, we have the same narrative down here, except of course turned on its head. Okay, so over here, what we had is, okay, where before we had an exhaustion of buyers, okay, right here we have an exhaustion of sellers. The sellers disappear in this case. Okay, and so right here again, supply and demand are in balance. Then all of a sudden there's an exhaustion of sellers, leaving in its wake only buyers, hence, and which of course is equated to demand. And so again, this is a demand zone. And so when price returns to that demand zone, we would then be looking to express a bullish trade out of here. Okay, and so one of course would buy the stock or buy a call, or again, if one wants to collect premium, execute a bull put vertical credit spread. Okay, so those again are all three simple ways of getting into a trade based on this supply zone here or this demand zone there. Okay, so that's the foundation of this setup here. And so if we now kind of flash forward in terms of the sequence, okay, price came up here, and let me just blow this up a little here. So here's what we were just looking at before. So price then came up here. Let's see, that was on the 18th. The prior slide, I think, had the date of the 14th there. So exactly 2 weeks later, price was here. Okay, it then hopped up here. Okay, and then at that point, then that was our entry for our trade. And so at that point, then this is where we got into some people just shorted the stock up here, and other people bought puts. Okay, and so in terms of the put, what we did was bought the 18 strike put expire with the expiration date of October 18th. So that was about 2 months out in terms of time. And of course, we want to buy enough time so we don't get crushed by time decay. And so that was the foundation for buying an option here. Okay, so price came up here, dropped, and then if we just kind of then I kind of blow this up here a little. So there was our entry again. We got into that option at $1.65. Okay, it dropped then over the course of about a week and a half, or I guess about 10. What is that? 2, 4, 6, 8. 9. So that's about almost 2 weeks of on the calendar, about a week and a half, about 9 trading days or so. 1, 2, 3, 4, 5, 6, 7, 8. Yeah. 9 yeah, so this is a little less than 2 weeks here. And so this was the trade here. So we got in at a $1.65, and we when we got down to this, and this was another demand zone that had formed below here, and so this kind of helped us to select a target. Okay, a demand zone formed over here, coming up after when price came up here, and then we also looked at the a couple of the Fibonacci extensions off of that measured move that came out of that zone there. Okay, so right there, the move from there to there, that's your full move. Okay, using the Fib extension, that's your full move there. So that's your halfway mark, and then this is the 38.2%, and that's your Fibonacci number there. And so, kind of generally, a lot of our trades, we find that our targets tend to be in between the 38.2 and the 50% there. So right there was our exit there. So on the option, we picked up about just shy of $1, and so based on $1.65 on a percent change rate of return, that's obviously sweet. That's about 58% that we got on that. So that was that trade there. So in fact, here's your summary here. So we got in, we got out of this on September 6th after getting in on the 8th, the 28th, I think we said. So we were actually in the trade for 11 days. It's 11 calendar days. Probably, I guess that was 9 trading days or 8 trading days. Labor Day might have been in there. And so again, we picked up 95 cents of profits, about almost 60%. Okay, the underlying moved about 3 to 1. Okay, and so if you traded a single contract, you made $95, and if you traded, of course, 5 contracts, you made $475. So that's the foundation for our trades. All right, so I hope that the little crash course on supply and demand was helpful there. So what I'm going to do now is we're going to go back to the we're going to go back to the market indexes here, and we'll kind of just quickly take a look at supply and demand zones that we have mapped out. But now you'll understand what the basis for those are. Okay, so this is where we are here, right here on the SPY. This was actually the all-time high that we had hit around mid-July here, and you can see we've now been back here. Okay, there was a supply zone that got formed there. It came back here a second time. We're now back there a third time. You know, some people would consider this, I guess, to be a double top. We're not really racing to short out of here. The fact that because for us, the more we pound on a level, the less reliable it's going to be, because essentially it's chewing up supply here. So it's quite possible we could get a drop out of there, but we're really just more content to kind of sit and wait. On the other hand, if we do get a drop out of here, where we would probably just be content to kind of wait for it to get down to this level here, and then this would be a good place to actually express a bullish trade here. We have what's referred to as a rally-based rally formation. Okay, this is an area of demand here, and particularly once we look at this in the 2-hour chart, this resolves nicely here. Again, here's the exhaustion of sellers that I talked about before. So this would be our setup here. We would express a bullish trade at around 534.5. Okay, but we would have to wait for that pullback there. Okay, so that's the story with the SPY. On the Qs, okay, we can see we actually already were down at this level, and this is actually a fairly similar level before, and we actually got a bounce out of that. So this, in fact, was the basis for a bullish trade on the Qs here. Okay, so right here, though, you can see that we are much further away from that all-time high than we were on the SPY. Okay, and this is actually a quality supply zone that hasn't been that is fresh. Okay, price has not been back there since. On the other hand, over here we had a supply zone here. Okay, and then notice price dropped here, but now we've been back here. We were back here once. Notice price drilled a lot into that. So at that point, it's already probably chewed up all the supply there. So we would not be looking to short out of here. So what we would be inclined to do is just wait for price to get up to here. Okay, so that's about 4% higher. So interestingly enough, now we have kind of two things to look at. One is that supply zone on the Qs that's 4% above, and then on the SPY, we got this demand zone here that's about 5% below here. So those are the kind of the two things that we're now looking at. All right. So that's the story with the SPY. Well, let's take a look at Microsoft here. Okay, so here, in fact, here's where we're sitting right now. And in fact, we're waiting on this level right here. Okay, so notice price is starting to kind of pop here. And so if we get up to here, and we're particularly looking at this in the 2-hour chart, and you can see there's a pivot here on the daily, but if you look at this in the 2-hour, in fact, let me just flip this over here for a second. So if we look at this in the 2-hour, okay, notice right there, price rallies, consolidates, and then drops there. We got that gap there, a very bearish candle there that closes at the bottom of its range. Okay, so this is an energetic, lengthy move in comparison to the depth of this supply zone here. So let me go back to the daily so everything kind of fits in one chart. There we go. So right there, that's our supply zone here. And so that's how the trade lays out. Okay, an entry there, stop out there. And again, here are the rungs for our risk and reward. Okay, over here, this was actually a nice trade that we had earlier, late last week and earlier this week. Or into this week, I should say. In fact, we actually closed this thing out Friday. And in fact, if I go to the chart here. This is actually what we were looking at on August 30th. Okay, so price was over here, came back, it started to bounce out, but it barely grazed the front of this, or it may have even missed it by a penny or two. And so this was actually the basis for the trade that I was just showing you. Okay, so that was kind of the before picture. And so if we now go back to the live chart, okay, there's your 407.06 level there. Okay, you can see there's your 397 over there. Okay, and if we go now to the live chart, you can see right there, there was that little kiss that happened before, which really was not appreciable. So that was considered to be a fresh level. And so when price returned here late last week, that was the basis of getting into that position there. And so it kind of ground up over the course of that week during that 4% move or so that the SPY had, or the 6% move that the Nasdaq had. And so Microsoft kind of moved nicely with that, of course, being obviously a major part of both indexes. And so we can see right here that was about a 2-to-1 move in terms of the underlying, and I believe in terms of the option risk that we had put on, given that it's an expensive share. All of our subscribers basically either bought calls, or a couple of people who are fans of selling premium did the bull put vertical credit spread that I described earlier. Okay, so that was so that's what we're waiting on here now. Though this level for us now is dead. So we're not waiting on that. We're not waiting for that. So right up here, these are two different supply zones. So we would certainly be looking. This one's actually we're real fans of this setup here because of the fact that we have a clear reversal there, and then these two very bearish candles, in fact preceded by a gap. Okay, so right here, here's our entry, there's our stop out, and again, this is where we would express a bearish trade. Okay, so that's the story with Microsoft. Let's take a look at NVIDIA. Okay, so right here, here's NVIDIA. And in fact, we were looking at this in the 2-hour chart. I got the note here, 2H. So that would be a 2-hour chart. So in fact, let me go to there. And let me in fact go back to a prior chart. Okay, so right here on oh, I'm sorry, I'm actually looking at the mixing up my ends here. Sorry. So anyway, let's just go back to NVIDIA here. So right here, we're actually sitting right in the middle of this supply zone here. Okay, price came up here, has now gone sideways. This is a supply zone though that's only done half of its job. Okay, it is stop price, but it certainly is not turned it around yet. So a number of us are in this trade now. We've kind of left it on over the weekend. A bunch of people have bought puts over here, looking for and expecting a price to drop to drop from here. But at this point, obviously, it has not done its job yet. So we're going to be sitting on that. All right. So there's that. And from where we are now, there really aren't any other trading zones until there's a fair distance down. There's a demand zone right here, about 10% down at around the 107 area, and then there's another supply zone here, and that's right there. Okay, this one was already used. In fact, this was the basis of a profitable trade, I think, that we had in here. But now this one is spent. Okay, in fact, the way we make the notation there is now it's no longer a fresh zone. So in fact, this is when we share this with our subscribers. When we see that, we know that it is a tested zone that worked, but now it's no longer active. It's no longer fresh. All right. So that's NVIDIA. Let's take a look at Apple. And we were looking at this, in fact, in the 2-hour chart. Okay, so here's where we closed on Friday at 222.5 or so. And so at around 228 to 230, there was a supply zone here. But then we also have this turn right there where price rallies, consolidates, and then drops very bearishly there. So in fact, this is what's referred to as a level on a level. Okay, and oftentimes with a level on a level is price will drive through the first zone and then it will turn at the back level, at the back zone. Okay, so this is the front zone, that's the front supply zone, that's the back supply zone. And so one needs to kind of figure out, well, how do you play this? So the way we advise our subscribers here is you do one of two things. Either you wait just for this thing to get to the back level and you just be really patient, and if it turns before then and then it becomes a successful trade, then maybe you just missed a successful trade. And it's just one of those things. On the other hand, if you want to get in here, then what you do is you put on essentially a half risk trade here. Okay. And if it drops like a stone, well, then you've got a real successful half risk trade. On the other hand, if it goes to the back zone there, then you put on the other half of your trade. Okay, and so then you put on the other half of your risk. So in other words, if you allow yourself $500 worth of risk, okay, you would put $250 worth of risk here. And if it works, great, you've got a $250 risk trade here that worked very well. On the other hand, if it goes back here, then you put on the rest of the position and you position size accordingly in terms of what the $250 worth of risk amounts to. And then at that point, your trade looks like one of two things. Either you're waiting for the price to get here, and then that's what your trade looks like here, or you treat this as a combined level. And what you do is you get in here and you have and you have your backstop right there. Because it wouldn't make any sense to get in at this front level, only to allow yourself to be stopped out in this little zone there, and then have it to go right back to that supply zone and work. That wouldn't make any sense. So either you have to trade this smaller top zone, or you treat this as a combined level. Okay, and of course, treating it as a combined level, it's obviously there's a lot more depth to it, and so your position size, of course, has to be reduced accordingly. This one, of course, will allow you to trade a significantly greater quantity because this zone here is about 1/3 the depth of that one. Okay, so anyway, that's the story with Apple. Taking a look at Amazon. Okay, so right here, and in fact, we're actually looking at this in the 2-hour chart as well. So price rallied here. Notice price came up. Okay, and then there was a little pullback here. It just kind of kissed it, and then it kind of rockets out from there. So in fact, we're looking at this as the basis for a bullish trade from here. Obviously we're going to need to see a pullback here, and that's about 5.5%. So there's that. And then above here, okay, and in fact, I believe this actually resolved better, I think, in the daily chart. Let me just quickly flip this over here. Yeah. So right here, notice price drops, consolidates there. There's these little rejection wicks there, and then notice then price kind of slams down from there. So right there, of course, you have your exhaustion of buyers that I described at the top here. Okay, and so when price returns up here, that would be the basis for expressing a bearish trade here. Okay, so this one again, this is a daily supply zone. And then this one down here, this was a 2-hour demand zone here. Okay, so those are the those are our two levels for Amazon. And then lastly, we'll wrap this up here by taking a look at Netflix. And in fact, Netflix, I believe, was the one that I had meant to look at earlier. So right here, this was actually a trade that we had last earlier this week. And in fact, this is what was based on a 2-hour chart. So let me flip this over to the 2-hour. And let me just pull this out here. Okay, so right here, here was a drop base rally formation. Notice price rockets out of there. There's a little pause, and then it kind of goes from there. Okay, so this is what we were looking at, though, and this is the there was that was the level right there, which we were looking at on August 30th. Okay, so right there's that level that I just showed you, and so we were waiting for that pullback here, and at the time we can see that that required about a 5% pullback. Here was the way the chart, here's the way the trade laid out. Okay, 665. Our stop would be at 658. You know, all of us, none of us actually bought the stock. It's just, it's a real expensive share. So of course, we expressed the trade using options. Okay, so if we go back here now, there's what we were just looking at there. Okay, and so when price came back, okay, it actually bounced here. We kind of got caught in the trade here. We was kind of dumb. A couple of people actually were smart, and they got out of it at 2-1. We were kind of looking at it, thinking we were going to get something closer to about the 680, get to about the 684 mark. That was that 38.2. Probably not the smartest way of managing this trade, admittedly, but we then caught a break. It kind of bounced down there, and then we ended up getting out right there. Okay, so that was the Netflix trade. So at any rate, there you go. I hope you found that useful. So that's actually the trade. Let me just see here. I think there was really nothing nearby here. Here's where we closed. Okay, this is now already a tested zone. This is really where the quality next quality demand zone here is. We will take a look and keep an eye on this little level right there, which is around the 646 mark or so. That's an area of sort of an area of interest. I'm really not that enthusiastic about it. I have to break it down a little further, but I don't really think it's that quality. I think really we just kind of probably want to wait until this thing gets down to the 635 mark or so. Okay, but again, that's about a 9% move. Now, having said that, once there's some further price action, we could have other levels that form. But as the chart stands now, this is what we're looking at, and so that's what we're going to do. Anyway, that's what I got. Thank you very much for the privilege of your time. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care. Bye-bye.